So guys, thanks for joining the next lecture in our webcast series. And this is the last one in building a full model. So this is really what our focus is going to be for the end of this year. And then I want to kind of go back and get your feedback and see if it's worth kind of doing more, continuing into the deeper modeling as per our textbooks, maybe modeling out a real company instead of a template, getting into valuation and M&A. As I mentioned in the beginning, the purpose of these series is really to simulate what you would get in a standard crash course, where in the crash courses, they kind of run through how to connect a model together, and we felt it was a little bit better to do it in a format where it's spread out over a series of lectures so you can kind of learn about different pieces and then take it home and kind of practice it so you can really hone in on those skills. So this completes building the model. I'm going to run through the debt schedule. I'm going to show you how it links together. This one probably won't take a full hour. And then I'm going to upload it. Hopefully you guys can use this as practice to build your own models with the original template that's in all the YouTube links. And then let's see how to dig deeper and what's appropriate. So I want to talk a little bit about the debt schedule just to kind of recap where we were at. We started the first lecture on the income statement, projecting out the income statement. Notice when building the income statement in any operating model, we leave out depreciation and interest expense and interest income as we're building this, because depreciation will come from a separate depreciation schedule, and interest expense, interest income will come from the debt schedule. That's the last piece. That's what we're going to do now. After the income statement, we project the cash flow statement. When projecting the cash flow statement, we also leave out depreciation. We also leave out deferred taxes. We leave out working capital. These line items come from the depreciation and working capital schedule, respectively. We also, when projecting the cash flow statement, leave out short-term debt and long-term debt borrowings. That will come from the debt schedule. We're going to do that today. So we project out the cash flow statement, and we realize at this point there's a lot of missing pieces. Basically, at this point, all of this is not linked in. So we think, or in terms of the process, the natural next step or the better next step in terms of our recommendation is to build now the supporting schedules that will help us fill out this section of the cash flow statement, which is the depreciation and working capital schedule. So after this, we went to the depreciation schedule. We built out depreciation two ways: straight line, accelerated. We created deferred tax liability. This depreciation linked into the income statement, right here, and also in the cash flow statement. Then the deferred taxes we created from the depreciation schedule also linked into the cash flow statement. We then went to build out the working capital schedule. We projected working capital, and these working capital line items built out this section of the cash flow statement. So now we have a significant enough portion of the cash flow statement ready to use to drive the cash flow statement. So in the last lecture, we used the cash flow statement to build out the balance sheet. And we talked about how to balance the balance sheet, how to keep the balance sheet in balance. Now we want to talk about the final schedule that kind of keeps the flow and continuity amongst the income statement, cash statement, and balance sheet. It's the debt schedule. So the debt schedule serves two major purposes. One, it tracks the levels of debt and the interest related to that debt that we have on our model. And two, it manages cash available. That cash available generates interest, and that cash available can also be used to pay down debts at will. If we generate interest income and interest expense, that is necessary for the income statement right here. If we decide to use cash to raise or pay down, use cash to pay down debt, or if we need cash and have to raise debt, those cash changes must be represented in the cash flow statement here. So this is really like, I think about like the keystone in the pyramid, that holds everything together. It also creates a very important and necessary circular reference that flows through the model. We'll talk about it briefly. We won't get into too much detail about it. If anybody wants more detail, it's in the book, Financial Modeling Evaluation. Again, the purpose of this scratching the surface webcasts is just to make sure you know how to link them all together and can talk about it in an interview. So the first step in any debt schedule, let me just kind of overview, is to look at the cash available to pay down debt. And the cash available to pay down debt, we'll get into this into more detail when we look it up, starts with the cash at the beginning of the year. all the cash flow that we generated during the year, and minimum cash cushion, which is cash we don't want to touch, cash that we want to set aside for purposes of maybe we just want like a safety cushion on our balance sheet. We don't want to have zero cash on our balance sheet. We want like a safety cushion for emergency. The next portion of our debt schedule is a list of all the debts that we have outstanding. Here's short-term debt. Here's long-term debt. And the interest related to those debts. That's the next section here. At the bottom of the debt schedule, we total items. We total any issuances and retirements. An issuance is a debt raise, a retirement is a debt paydown. And we total all the interest expenses. That will be linked into our income statement. We also finally measure the cash at the end of the year, and we link that through as well. So the way I like to think about this is we have managing the cash, we have managing the debts. Okay? And when you're modeling a template and then adjusting the template for real-world practice, the first thing I would do is I would look at the debts that are outstanding as per the balance sheet, and I would adjust the template to make sure that there is a debt section for each debt that's represented on the balance sheet. So this company has just short-term debt and long-term debt. Let's look at the balance sheet. They have just short-term debt and long-term debt. Very easy. So on the debt schedule, they have two debt sections, one for short-term debt and one for long-term debt. So the first thing you would do from a mechanical perspective is go to the balance sheet of your company and see how many debts they have outstanding. If they have 5 types of debts, you'd want to create 5 debt sections here that match the names of the debts the company has outstanding. The second thing you'd want to do is link in from the balance sheet the last reported values of debts and cash. So if your company has 5 debts and you've layered out 5 debts here, then at the end you can see here short-term debt at the end of the year, long-term debt at the end of the year. You want to pull this in from the balance sheet, the last reported balances. So it's already linked up here, but this comes in from the last reported short-term debt, because we're going to use this to build out our future debts. We also want to link in cash at the end of the year, the last reported cash, again from our balance sheet. That's the first mechanical step. The next thing I recommend doing is to build out each piece of debt. And when I say build out, this is going to be a running balance. So if you see at the top here, we have short-term debt at the beginning of the year. This is going to be linked in from the prior year's ending debt balance. So the idea here is, let's say the short-term debt at the end of the year is December 31st, 2011. Next year, which is presumably the day after, which is presumably January 1st, 2012, we assume the debt's not going to change in one day or overnight. So the short-term debt at the beginning of the year will be equal from the prior year's debt balance. Okay? We then have 2 line items here. They both represent certain types of issuances and retirements. One is listed as mandatory. One is listed as non-mandatory. I'm going to hard code them 0 for now. I'm going to talk about them briefly and save details of this for a next level discussion if we get into that, but it's in the book. The reason why there's 2 is because mandatory, first of all, from an accounting perspective, they act the same. I want to make sure that that's clear. And issuance is a raising of debt. A retirement is a pay down of debt. In modeling, we separate the line items because when debt is issued, oftentimes debt might come with a principal repayment balance. In other words, you raise $700 in debt, and part of the term is you're required to pay back $100 every year. That's a mandatory retirement. It was mandated from when the debt was raised or when the debt was issued that you have to pay down a principal, like a mortgage. Right? Oftentimes, though, in modeling, and the purpose of the debt schedule is to see if you happen to have cash above and beyond what was reportedly planned. And if you do, you might choose to pay down debt above and beyond what's mandated. That's non-mandatory. So if you happen to have a cash surplus and you choose to pay down debt that's above and beyond the required principal payment, we want to do that and not interfere with the mandatory. So we have 2 separate lines. One for, again, the mandatory principal payments, and one that's kind of ad hoc to say, okay, we have a little bit more cash this year. Let's maybe pay down debt because that's going to give us extra interest payment savings. That's why we have it separate. For now, we're going to hard code them 0. And the point is, whether it is mandatory or not, if you have an issuance, the debt at the end of the year in that year is going to be a sum of the beginning debt and anything that's been raised or paid down. So a quick way to sum, we mentioned in earlier lectures, is all equals. If you do all equals, if you have I don't know if it works for a Mac or an Apple. I'm not quite sure. All equals, and you hit enter. And so this is 700, but the idea is if we want to raise debt, I'd put 100 in one of the mandatory or non-mandatory issuance line items, and the debt balances would go up. If I want to, however, pay down debt, I'd put in negative 100, and the balance would come down. And if I copy this whole section to the right, I'm building a running balance. Okay? And then we want to calculate interest expense off of that balance. So how do we calculate interest expense? Well, it's a debt balance times the rate. But in modeling, we take an average debt balance. We take an average debt balance of the prior year and the current year. Why do we take an average debt balance? Well, there's a good reason for that. If I, for example, ended up paying down debt in this year, okay? Since this is a yearly model, I don't know exactly when that debt's been paid down. Right? Now, if I had paid down debt on the very last day of that particular year, that pretty much means I've incurred a full year of interest expense, because let's say I didn't pay down that debt until December 31st. So I have 12 months of interest expense. But what if I paid that debt down on the first day of the year, January 1st? Then I would have virtually incurred 0 interest expense. I don't know. I don't know when I've paid down that debt. So if I had linked up interest expense times the debt at the end of the year for my interest payment, then it would imply that I've incurred no interest during that year, and the implication would mean that I've assumed that I've paid down that debt in the very beginning of the year and incurred no interest. But I don't know, and because I don't know when, to play it safe, I take an average. I take an average of debt balance this year and the year before. That assumes whenever debt was paid down, I don't know if it was paid down at the beginning of the year or the end of the year, I'm going to take an average to mitigate that. Now, some people ask me, well, what if you want to kind of adjust for the day? And I guess you can, but you know, if you're going to get to that level of accuracy where you want to kind of make sure you're paying down debt in a specific month, then you should be building a monthly model, not a yearly model. So for that purpose, whenever we calculate interest expense, we take the average. So we do equals AVERAGE, open parentheses, debt at the end of this year, debt the year before, times the interest rate. Okay, and you hit enter, and we copy to the right. So this is kind of averaging the idea, well, I don't know if I paid in the beginning of the year or at the end of the year. I'm going to assume it was somewhere in the middle. And if I zero this out, this is going to give me significant interest. And you do this for every debt that you've laid out in your template. So, for practice, I'm going to do this very quickly for the long-term debt, and I'm going to pause and give you a minute or two to try to catch up. Okay, so I'm going to do this very quickly. I'm going to say short-term debt at the beginning of the year, long-term debt at the beginning of the year equals long-term debt from the year before. 0 for the issuances, sum everything up, take an average. Average of this year and the year before times the rate. As you get more efficient with this, you'll be able to do it quicker. So I'm going to pause, take a minute or two to catch up. Okay, thank you for that. Somebody posted a question. I just needed to, in this formula here, G23, just make sure that the parentheses are within the average formula. So if you make that change, that's going to give you 50. Thank you for that. I appreciate that. Another trick, if you're trying to become efficient doing this, I could have just taken this whole section because the formula is identical. And I'd copy, Control-C, and I'd go down and hit Control V, and it does the same thing. So if you're dealing with a situation or a complex company where you have like 5 or 7 debts, you don't have to do this each time. You can highlight the section and just Control C, copy V 5 times. 1, 2, 3, 4, 5, and everything's in there. Okay, once you have this, we can start totaling some items. We can total up the issuances, which is a sum of each of the mandatory and non-mandatory issuances. Okay? We can also sum the interest expenses. There are 2. Okay? And before we start to do cash at the end of the year, we have to now look more closely at cash at the beginning of the year. And just like debts, it's a running balance. Cash at the beginning of the year is going to be equal to the cash at the end of the year from the year before, which we will copy to the right. Okay? Now we have this line item called cash flow before debt paydown. This is a very important line item, and this is going to help us determine how much free cash do we have to pay down debt. So the purpose of this whole section, first of all, is because we want to see if we have cash that's available to pay down debt at will. And so there's a little calculation for that. We always start with the cash that's sitting in our balance sheet, right? What's the cash at the beginning of the year? This is our cash balance. And then from there we want to say, okay, how much cash do we generate this year? So to figure out how much cash we generated, we naturally look to the cash flow statement. However, these 2 lines are going to convolute things because these 2 lines represent cash paydowns, and it becomes recursive. It becomes circular. We don't want to pull this cash number, even though this cash number is basically how much cash has been generated, if later on when this gets linked fully through, this represents, let's say, minus $4,000 in debt paydown. I don't want to take this number because my point is I want to figure out how much cash has been generated before the debt paydown. Cash flow before debt paydown. So what I want to do is I want to recalculate my cash top down, but exclude the line items that are related to debt paydowns to avoid double counting. I want a measure of cash that does not include debt paydowns in order to determine how much cash I have for debt paydown. So this is going to be a sum of the cash from operating activities plus cash from investing activities plus a sum of every single line item that does not include debt paydowns. So although the number looks identical right now, later on in time, if we have debt paydowns, for example, 4,000, the number will change because this is going to represent the net after debt paydowns. This is going to still hold to the number before debt paydowns. And I actually should have done this here. I can just copy this left and right all the way through for every year. This number will link in to our debt schedule. Okay, so here's the formula again. Cash from operating, cash from investing, and all the line items that do not include the debt paydown. This will link in to the respective line item in the debt schedule. Cash flow before debt paydown. Link in from the cash flow statement. Okay. And then our total cash to pay down debt is going to be a sum of the 3. And the way people look at this, the way we look at this from a modeling perspective is, okay, first, here's the cash that we started with. That's the cash in the balance sheet from day 1. This is the cash we generated this year, excluding the cash from debt paydown. So we want to add these two to determine how much cash we have available to pay down debt. This minimum cash cushion, this is cash we don't want to spend. So we're going to remove that. This is the cash that we can spend to pay down debts. Copy this to the right. Now, I want to point out something very important that will happen once we link things through. Once we start linking up interest expense and interest income, there will be a circular reference in the model that's intentional. It is because of the cash and the interest. I want to link up the interest, and I want to show you what's going to happen. So right now we have 11282.9. I'm going to type it on the side here. So you know, 11282.9. Okay. What I want to do now is I want to, because we have total interest expense down here, I want to link this in to the income statement. Okay. So if you go to the income statement, we have two lines, interest expense, interest income. Let's link interest expense in from the debt schedule that we just calculated. Okay. That should flow through. Okay. Let's go back to the debt schedule. Look at the cash. The cash went down. And the question is why? Why did the cash number change? Because we linked up the interest expense. Why did that change? And the reason why, and this is part of the circular reference that I want you to start thinking about, is when you link interest expense into the income statement, there's added expense. Added expense will reduce net income. If net income goes down, remember, net income starts the cash flow statement. If net income goes down, cash is going to go down. If cash goes down, this number is going to reduce, which will reduce this number. Basically by the total interest expense value adjusted by the tax. That's the value that it reduces. So in other words, this has linked in to the income statement, which reduced bigger expense, reduced our net income. This has gone down. That goes down, that starts the cash flow statement. That goes down, net income goes down, our cash goes down. This is the number that's changed. Okay? I'm going to take this one step further now. Let's say I look at this and I say, okay, I have 11236.8. I can now pay down debt. I have enough cash to pay down my debt. So I'm going to put minus 700. Before I hit enter, watch the cash. The cash is 11236.8. I'm going to hit enter. What happens? The cash goes up. Now, why did the cash go up? This is because of the circular reference that we're creating. I paid down debt, yet the cash went up. What's changed? Well, I'm going to undo this. This is what's changed. The interest expense was 21. I put a negative 700. The interest expense goes down. I have less expense. What happens when I have less expense? This number goes down. It was 71 before. I have less expense now. My net income has gone up. If my net income goes up, net income drives the cash flow. This cash goes up a little bit. The cash has gone up because of my interest expense savings based on the fact that I've paid down debt. But you might be thinking, well, you paid down debt. How come your debt hasn't gone down? How come your cash hasn't gone down by 700? Remember, this is cash flow before debt pay down for a reason. This is to determine how much cash we can use to pay down debt. And it's recursive like that. So let's say now I can pay down another 1,000 more for long-term debt. If I do that, this cash is going to go up more because I'm going to save in more interest expense. I pay this down, 243 went to 11,259. My interest expense was 71. It got cut in half because I paid down the debt. Interest expense went down, lower expense, higher net income. Net income drives cash flow, higher net income, higher cash. This has gone up a little bit. Very important to be able to walk through this to fully understand the model, the way it's flowing, and you might be asked this in investment banking interviews. So I'm going to zero this out, okay, and I'm going to continue. The next thing I want to do is calculate cash at the end of the year. The formula for this, I want to make sure it's important that you understand what the formula is and why. And what we do is we start with cash at the beginning of the year. Okay. We add cash flow before debt pay down. Think about the point of cash at the end of the year is determined how much cash do we have by December 31st, 2012? Well, we start with how much cash we started with. Well, we start with the cash at the beginning of the year. Then we add in how much cash do we generate before debt paydown. We basically ultimately want to know how much cash do we generate for the whole year. But this is missing something. This is missing the cash due to debt paydown. So I like to think of this as like a timeline. So if I want cash at December 31st, 2012, here's cash at December 1st, 2012, 71.8. This 3935 is cash from that January 1st all the way to December, but it's missing something. It's missing the cash due to debt paydown. That's the last missing piece. Where do we find the cash due to debt paydown? Total issuances and retirements. Issuances and retirements is cash issued or paid. That's the debt paydown. So cash at the end of the year is cash at the beginning of the year plus cash flow before debt paydown after total issuances and retirements. And if you link that up properly, this match should be yes. Throughout these courses I've spoken about these matches. There are several matches in the model that help us ensure that we're building the model with proper flow and continuity. And what this is doing is making sure that the cash balance that we've calculated here matches the cash balance on the balance sheet. We're calculating cash in two different ways. On the balance sheet, it's cash flow from the year before plus the cash flow statement, completely independent of the debt schedule. In the debt schedule, we're calculating cash completely independent of the balance sheet. We're calculating cash in a different way from using all the numbers within its schedule here. So we're calculating cash in two different ways. This is a great cross-check to make sure the model is linking up properly. Just like we have interest expense on debts, we have interest income on cash. This is the income, small 1%, 1.5% of cash sitting in maybe your Chase bank account. Maybe you're getting a little bit of income. So we're going to calculate the average, open parentheses, cash at the end of the year between these 2 years times the rate. That interest income gets linked in to the income statement. And if you remember in the very, very beginning, we spoke about how interest income actually is in parentheses. It's in parentheses, not in every model. It's not like an SEC or GAAP requirement, but in a lot of models to differentiate from expenses. So, in an income statement, with the exception of revenue, expenses are usually listed as positive numbers all the way down. And so a lot of companies or a lot of modelers, when you see an income line item, they show it in parentheses to make sure it's differentiated from an expense so that you don't accidentally see this and say, oh, it's another expense, not reading the title. So in order to avoid that mistake, a lot of people put income in parentheses. And so we're adding the two together. So interest income we're going to link in as a negative. Sorry. And this will subtract, right? So this is basically a net negative, meaning we have an expense, we have a little bit more income than expense, so this is actually going to increase our EBIT, and it does. Okay? So that's linked in. We're almost done. We have one final link in the model. We have to make sure any debt issuances or retirements get linked through to the model. We didn't do that yet. If I had paid down $700 in debt here, this will no longer match. And it will no longer match because we've paid down debt on the debt schedule, and the cash at the end of the year here has captured that. But that debt paydown isn't represented anywhere in the rest of the model. It's not represented in the balance sheet. Look, the short-term debt hasn't gone down. It's not represented in the cash flow statement. There's no indication of debt paydown here. This is still the high number before the debt paydown. Why? We have to link through any issuances or paydown of debts from the debt schedule. So that's why in the short-term debt, I'm going to link this in from the debt schedule, the mandatory plus non-mandatory short-term debts. So I linked in from the debt schedule, debt paydowns, plus G13, G14 to represent the debt paydowns. What happens now? Cash goes down, flows into the balance sheet goes to zero, we're matching again. That is the final, these are the final links in the model. We have to do the same thing for long-term debt. Long-term debt needs to link in from mandatory and non-mandatory issuances. Every debt that you lay out in the debt schedule, if there's a paydown or an issuance, must flow into the cash flow statement. Otherwise, the model won't be complete. I'm going to zero this back out. The model's complete. And as a check, everybody should have, this is a good check, the same exact number, 46753.3 in this model. The debt schedule, you know, it's a little confusing for a lot of people because it's not very linear. Every other statement, you build 2012 and you do a big copy right. This is not like that. You know, the balance sheet has, you know, a set of linear formulas, cash flow statement as well, even the income statement to some extent. But the debt schedule is a little bit more haphazard. You're pulling in things from the balance sheet, you're doing running balances, you're totaling things, there's a circular reference. But that's why we slowly dig deeper as we go on, all the way up to the leveraged buyout section of our course, where because a leveraged buyout focuses heavily on debt, the debt schedule is a major component. But this completes the model. It causes a circular reference, which is important to understand how it flows. And the final two links is interest expense and interest income, links into the income statement, which we have done, and mandatory issuances and retirements, links into the financing activities of the cash flow statement. Once you've linked that up, you're done. So as I mentioned before, this probably won't be a full hour, and it's not a full hour because we're just finishing the debt schedule. We're done with the model, we're done with the template, we're done with the first task. I'm going to pause for a couple weeks and see, you know, what direction to take this. If there's a lot of you guys that are interested in going further, we can go further, either digging deeper and building a fuller model, then getting into valuation, then getting into M&A and LBOs. I'm going to have this saved and uploaded and sent out with an upload to the link to the video, and we can take it from there. So I want to thank you guys for your time throughout the, I guess, last 2 months and the last 5 webcasts, and I hope we can continue this. Again, just look for an email in the next couple of days, and we'll take it from there.